All right, what's going on, my full circle family? It's your boy, Official Go Getter. I'm coming at you guys with the Sunday watch list. Right, moving forward on Sundays, you can expect me to create a little watch list and create a little something for you guys, just so you guys can have market insights and just a recap of just what's going on and just more learning. Right, so Sundays will be Sunday watch list talking about the stocks on my end, and we'll add crypto and eventually we'll do it live and whatnot. So first, what I want to talk about is the notable earnings that we have coming up on Thursday, right? So earnings is when the companies are legally obligated, since they are, so because a company is on the stock market, this makes them a public company. And when you are a public company and you want people to invest into you and place yourself in the stock market, a you are legally obligated to show what you do with your finances. So how much money you make, how much money you're bringing in, how much money is going out, what you're spending your money on, right? So this week we got FedEx and we got Nike, and I thought this would be a perfect example to explain to you guys why sometimes a company that we know is very well known is not a good stock, right? So something that we can start with is FedEx, right? So FedEx, right, is a good company, something that we all know, something that we all see, right? But for some reason, not for some reason, we're going to dig into the reason as to why their stock struggles. So with FedEx delivery system, it's a complicated system, and due to this complication, it is less efficient than it is compared to its competitors, such as Amazon or such as UPS, those other delivery companies, right? So they have this system that if one thing messes up, right, um, everything else falls. So that ends up taking more money out of their pocket, and just because, and due to the system not running as efficiently, this doesn't let them profit as much as they want to. So what that means is that eats into how much the company actually takes home. So if a company makes 40 million in 1 year, how much did it take for you to make that, right? FedEx on their end is taking them way too much money, and sometimes they may be going into the negative just to make their revenue throughout the year, right? So until they clean that up and get things more efficiently moving and manage that complex system, it will always be a company that we see but will struggle on the back end, right? And we look at it by digging into their financials and understanding um, the numbers on their finances, right? How much money is coming in compared to going out, right? And how much is their profit percentage? How much do they actually see and take home, right? So Nike is another company that has been a well-known brand that we all know, but has been a company that has been struggling, right? So Nike has been struggling, and we think that it on the outside we just see Nike, right? But on the inside, right, what's been going on with Nike is the fact that they haven't been able to profit as much either, because they pay too many people just to sell their stuff. So something that Nike has been doing is trying to cut out the middleman and get us as consumers to just buy directly from them. So they have been taking their shoes out of Nike. I'm sorry, your shoes out of Foot Locker, Dick's Sporting Goods, Famous Footwear, all the other places, and even online places when it comes to online brands, right? Um, they've been taking their stuff off there so then that people can go buy directly from them, so then they can cut out the percentages that they're paying the middleman, and then they can build that online loyalty. So the thing that is making this a little bit difficult is the fact that we are comfortable with going into Nike in a storefront, a physical store, and spending their money, but a lot of consumers aren't comfortable giving Nike the same type of money online. So then they have to build their online loyalty and show that they're capable of producing the same type of customer service online that they are in person, right? So next we're gonna move on to averaging down versus dollar cost average. So what's going on in this economy, man? It's important that I touch on how to actually place your money, because you'll hear a lot of people say buy the dip. So what it actually means to buy the dip and how to buy the dip. So buying the dip is buying the companies that are, we call it on sale. So when quality companies and when the stock market and when the crypto market is on a crash, right, this is when you should buy, because you get quality assets on sale. You never want to buy the assets at the top. You want to wait until the dip and you buy during that dip. But now I'm going to talk about the two ways to buy during that dip. So you have averaging down, right? So averaging down is buying a stock after significant price drops. So let's say you buy 15% below the high, then you buy again 10% below that drop, and then you buy again at that next drop. So let's say you have $1,000, right? And let's split it into, um, let's do 303. Let's do 302 times, right? And then you got your last 400. So say you got $1,000 and you want to put it into Bitcoin. Let's say Bitcoin, right? Or any stock, right? So when Bitcoin falls 15% below, right? When it falls 15%, you want to place $300 there, right? But then you also understand that we're still in a bear market. It could still drop, right? And when I say bear market, a bearish market is a down market when you see red, and a bullish market is when you see green, right? Hence, bull strike up, bear strike down. So that's the market terminology. So when you see, because we know that we're in a bear market, that first drop may lead to another drop. So that 15% drop, you may see another 10% drop. So you place $300 on that first 15% drop, and then you would place another $300 on that 10%, right? And if you think it's going to go a little bit lower before it goes back up, say it's another third 5-10% drop, you deploy the rest of your $400, right? The rest of your money, right? So then that is how you average down. That is how you actually get into the market at price points that are solidified and give you conviction, right? But the only thing about this is that it can lead to large losses if the stock continues to drop. So this is why we only do this with quality companies, because whether or not the stock drops, you know the stock is going to come up, right? But all you're trying to do is get in there at a good price, which is 10 to 15% below its all-time high. If you're doing that with a quality asset or a quality company, you're in the green. You bought it at a good price, you're good, right? And then you have dollar cost average, right? So dollar cost average is consistently investing a fixed amount at regular intervals, regardless of the price. So an example would be investing $200 into VOO or Apple or Bitcoin, right? You're investing $200 every month, no matter what the price is, right? So these are two examples of dollar cost average is time in the market, and then averaging down is timing the market, right? But you're just combining both, right? So average down requires strong conviction and analysis, while dollar cost average is a more consistent and less risky approach. So dollar cost averaging may be easier for beginners, but then when you get past that stage, you want to average down, and then you basically are dollar cost averaging with precision, right? So next we are going to jump into how to base your investment decisions. So this is exactly how I base my investment decisions, so then you can remove all the fear. So your decisions should be based on data analysis, technical analysis, and fundamental analysis, right? So data analysis, it comes with examining the historical trends, right? Market statistics and financial reports to identify and insights, right? This includes looking at things like sales, numbers, growth rates, and economic indicators, right? So that's data analysis is taking the data that is today and then comparing it to the past data. So let's do data analysis on Microsoft would be a good company to do it on, or maybe even Amazon, right? So we can do data analysis on Amazon, right? um, so we would compare where it's at right now at that 197, and then some data analysis will be looking back. Okay, what did it do in the previous? What did it do last time we was in this situation, right? Let's say last time we had came down to this price, right? We ended up coming right here at this 197, and then you can see that around this area we ended up bouncing up, right? Even down below, you can see by the past data around here is when we started to move to the upside, right? So we would use that and take that in consideration for data analysis, and then you would use technical analysis. You would use the price chart to tell you precise entry points and where the market is reacting, right? So let's use technical analysis as well. So this is the 52-week high, but then we took our price tool and we put it below 20%. So we want to buy in 10 to 15, between 10 and 20% below the 52-week high. So our first price point would have been right here at 10%. We can already see right here, due to the technical analysis, this is an area where we saw consolidation, where we saw price come to and kind of just level it out, right? And that's already 10% below the first high. So this would have been, okay, buy here at 218, right? 10% low. And then you would go even lower. If it goes lower, right, you got the 20% drop, which it already came down to this type of level right here, and it came right back down to it. That's using technical analysis and using the chart to tell you the precise entry points on where the market is reacting. So when I tell you guys to buy at certain price points, and when you hear people say buy at certain price points and buy the dip, this is how you want to use that to gauge where you should actually buy, right? Not just buying in a random area. No, you're buying in an area where price has come to and leveled out, and a lot of buyers and sellers and a lot of you could say liquidity, right, is in this area. So so right here, that's using data analysis, right? What happened in the past data, right? Then you're using technical analysis to tell you your entry points and where the market is really reacting, and then you use fundamental analysis. So that's when you're looking at the company's earnings, their debt, their management, and their industry position. And then you also take in consideration what is going on in the economy to see how the economy will either benefit or it's not going to benefit. So just when Amazon, we can come here to their financials and we can know that Amazon is a good company, right? So let's look at more financials, right? So if you look at their income statement, right, Amazon is not just a good investment just because it's a good name. No, it's a good investment because it's a good company, and based off the numbers, that's what tells us it's a good company. So something we want to look at for the revenue is from 2023 to 2024 or to now, right? Let me go back. I just did something wrong. My bad, guys. But when we look at this right here, we got it back right. So in 2023, they were at 127 billion, and now 2024 they're at 187 billion, and then the trailing 12 months they're at 630 37 billion, 0.96 billion. So this right here is just demonstrating that year over year their revenue is growing, and that's what you want to look at, right? Even their gross profit, the money that they're taking home all the way. So that has grown from 59 billion to now 88 billion, right? Their operating income, right, that's also grown. So when you look at that, you want to come here and look at their income statement, their balance sheet. Their assets have grown. Their liabilities are less than their assets, right? And then they have their cash flow has grown. The cash flow is the amount of cash they have on hand to handle business opportunities and handle other things, so then they can invest and to make the business even greater than it already is, right? So taking a look at all these things is very, very important, and this is how we build our investment decisions with conviction, right? So that's looking at fundamental analysis, technical analysis, and data analysis. And we just did a nice, real thorough breakdown on Amazon to know why this is a good company and why you should buy at this dip, even though this company is low, right? Why am I still buying? We just went into why, and honestly, Amazon is my favorite company. Not a lot of people know that, and if you do, you do know. You do now. If you don't, you do now, right? So this approach, this provides conviction in your price points. This removes that fear for when you have your investment going, and when you have your money in the stock market. This is how you remove that fear, and you base your decisions based off of real knowledge, real data. So something I want to touch on is the fact that yes, we see all these companies down, the Magnificent Seven, right? And the Magnificent Seven consists of Apple, Amazon, Alphabet, which is Google, Meta, Microsoft, Nvidia, Tesla, right? These are the Magnificent Seven companies and the tech companies that actually move our economy. They make up of most of the profits that we see into the S&P 500, which is the top 500 companies in the U.S., right? So is the Mag 7 still magnificent? And the answer is yes. They are very much still magnificent, but they are just having a great moment, or not so great moment, which is very understandable. So once again, they had the best year ever they did last year and the year before that. So let's talk about that. So Apple did approximately 48% in 1 year. Amazon did 81% in 1 year. Google did 58% in 1 year. Meta also did 194% in 1 year. Microsoft 57% in 1 year, and Nvidia did 239%, while Tesla did 102%. Right, so if we take all that into consideration, right, the companies are just doing what they're supposed to do after they've had 2 great years in a row, right? Honestly, they're just taking a breather, and that's what they need. So then we can actually have an opportunity to get into these companies at a good price point, right? So this is why you don't be afraid when you see quality companies and they drop below, right? This is why other investors and why I'm not afraid when I see these quality companies and drop below. When people say, "Oh, that stock is down," or "Oh, this stock is down," that's okay. Let it be down. They can be in fear, and you buy when people are fearful, and you sell when people are greedy, right? So, I just wanted to touch on that for the Sunday watch list, man. You can expect these for coming forward from me, right? And eventually we'll do them live. So then my boy Flash can get up in here and talk about his crypto as well and break down that stuff to you guys. But for anybody who tunes in, man, I appreciate you guys coming. I appreciate you guys tuning in, and that's that, right? So just let me know if you have any questions. It's your boy Official Go Getter, and I'm out. Have a good week. Let's all have a good week. We got Wealth Wednesdays coming up. I better see everybody there for Wealth Wednesdays. All right, I'm out.